Okay, let's jump right into this explainer. Demystifying USD.AI, also known as CHIP, the promise and the trap. Right now, we're looking at arguably one of the most talked about projects in the entire crypto and AI infrastructure space. And honestly, for very good reason. On one hand, you've got this truly groundbreaking technological solution to a massive real world problem. But on the other hand, well, you're looking at a trading environment that is essentially a minefield for the everyday investor. So today, we're going to break down both that undeniable promise and the hidden traps so you know exactly what you're stepping into. To really grasp the sheer scale of this phenomenon, just look at this number, a staggering $1.3 billion in 24-hour trading volume. And this sits in stark contrast to the token's relatively small $200 million market cap. Just process that for a second. The equivalent of the entire project's value is changing hands 6 to 7 times over in a single day. That's like a house being bought and sold 6 times in one afternoon. Even highly speculative assets rarely sustain that kind of velocity. It immediately tells us we aren't just looking at organic, long-term accumulation. We're witnessing an intense, hyper-concentrated frenzy. So part 1, financing the AI revolution and the real-world utility of USD.AI. What's absolutely fascinating here is the massive, legitimate utility actually driving those billion-dollar numbers. Let's define exactly what's going on under the hood. USD.AI is directly solving the huge capital bottleneck for artificial intelligence infrastructure. Look, AI companies desperately need to scale their compute power, right? To do that, they need expensive enterprise-grade GPUs. But acquiring massive GPU clusters requires serious upfront capital. By tokenizing these GPU fleets and turning them into liquid on-chain collateral, this protocol creates a brand new credit market that's specifically tailored for the AI age. Now, you might be wondering, why are AI operators flocking to this over traditional banks? Well, imagine trying to explain what a GPU cluster is to a traditional bank loan officer. By the time they actually figure it out, underwrite the loan, and issue the capital anywhere from 6 to 24 months later, that hardware is already obsolete. Enterprise GPUs lose about 20% of their value every single year. USD.AI just bypasses that entire legacy system, compressing the funding timeline to under a week. It's a total game changer for operators moving at the breakneck speed of AI. And look at these metrics. They confirm the protocol's undeniable traction. We're talking massive institutional backing here, not just empty meme coin hype. $658 million in total value locked, $1.2 billion in approved financing. They even secured a $500 million institutional facility specifically for Cumulus AI, plus integrations with PayPal's PYUSD. These are heavy-hitting numbers proving major players are actively using this network to generate real yield. But part 2, the extreme volume trap. This is exactly where hype becomes hazardous. Right when you're totally convinced of the protocol's merit, we need to sharply pivot and look at the highly dangerous retail trading environment currently surrounding it. Remember that volume we talked about? When trading volume outpaces market cap by 5 to 10 times, it signals a frantic, speculative frenzy dominated by arbitrage bots and day traders. The exact same capital is just rotating in and out continuously. Plus, the token launched simultaneously on 7 major exchanges. That creates a highly fragmented, deeply leveraged playground where liquidity can literally vanish just as fast as it appears. And then we have this major yellow flag from Arkham intelligence data. Early investors are shifting massive holdings to exchanges, likely preparing for coordinated profit-taking. Remember, this token launched at just 3 cents on CoinList before rocketing up past 11 cents. So when a single wallet holding over 17% of the total supply starts moving tokens to hot wallets on places like Gate and Robinhood, well, they aren't doing it just to hold them. They're staging those tokens for distribution. Which brings us to part 3, beware market maker manipulation, navigating the whales. In this kind of environment, you're not just trading against other retail buyers. You're stepping into an arena with algorithms and institutional players. Let's map out this ruthless 3-step stop hunt tactic to show exactly how retail traders get liquidated. First, the lure. They let the price creep up slowly, building a false sense of safety so traders enter leveraged positions. Then, the spike, a sudden push directly into where they know everyone placed their stop losses. Once those stops are hit, it triggers a cascade of forced selling. The price drops artificially low, and the market makers just scoop up the discounted tokens. It's a completely engineered trap. Need proof? Take a look at this. $1.83 million. That's the amount of long liquidations wiped out in just 24 hours. It perfectly proves that traders who chase the momentum are actively getting flushed out. In a recent pullback, long liquidations were nearly 3 times higher than short ones. That's not a healthy market correction. That's inexperienced traders getting forcefully removed from their positions by the exact mechanics we just broke down.
Okay, part 4, the looming supply overhang, a tokenomics reality check. Beyond the daily chart manipulation, we've got to examine the long-term structural danger baked right into the tokenomics.
This chart brutally highlights the reality. All this wild price action, it's happening with only a tiny fraction of the total supply actually available. There are 10 billion tokens total, but the public is fighting over just 20% of them, 2 billion tokens. The other 80% is completely locked up. So the current market cap isn't telling you the true future valuation of the project at all. While we are in a fractional supply safe zone right now, look at this timeline. There is a ticking time bomb waiting in April 2027 when early backers can finally start dumping their tokens. They have a 12-month cliff, meaning right now they literally cannot sell. But once we hit month 12, boom, a massive 33% of their holdings unlock immediately, followed by linear unlocks for 2 years. Today's price is pricing in a massive dilution wave that hasn't even hit the shores yet. So, part 5, how to trade safely, the survival toolkit. How do you actually protect yourself in a market split between incredible tech and predatory trading? You need a structured, highly defensive approach. Here is your specific survival toolkit. Strictly utilize these technical indicators to avoid getting caught in spoofed orders. Verify breakouts with VWAP. If the price goes up but the on-balance volume is falling, don't trust it. And this is crucial. Set your stop losses using the average true range, placing them well below the obvious psychological support lines. That is exactly how you avoid those stop hunts. Oh, and always monitor the on-chain data for those whale exchange flows. As for the current battlegrounds, keep an eye on these exact support levels. We're talking the 0.618 Fibonacci retracement level near 9.2 cents and critical support at 7.5 cents. If the price breaks below those levels with high volume, the technical structure turns incredibly bearish. If buyers fail to defend that cluster, the floor could open up fast. Which leads us to our final thought. Ultimately, this is the vital question you must ask yourself. Will real AI yield outpace token dilution? You've got to balance the legitimate AI utility against the relentless market maker manipulation. Can USD.AI grow its loan book fast enough to justify its valuation before that massive 80% token unlock hits the market next year? It's an absolutely fascinating standoff between revolutionary tech and ruthless tokenomics. Will the tech justify the token, or will the whales just eat the minnows? I hope this explainer gave you the clarity to navigate it all safely.